Small value stocks are cheap, says Larry Swedroe over at Advisor Perspective. So let's see what this is about. So I'm a big fan of Larry. He writes for, or he's part of the leadership team of Buckingham Asset Management. I don't even know what it's called. They've changed their name, but I'm always interested to hear what's cheap out there. And Larry says small value are cheap, and if we look historically, small value have outperformed everything else domestically, going back to basically the start of the modern era of 1926. So let's see what old Larry is saying here. Line 8/8/2019. Historically, small value stocks have been the best performing equity class. But the last 10 years has been a period of dismal performance. With their valuations now at historically attractive levels, small value stocks are priced to outperform. I like when actually people say that. When they say they're priced to outperform as opposed to, well, maybe or this. I mean, Larry is weighing it out, saying he believes that they should outperform. At least that's the way I understand what he's saying. From 1927 through 2019 June, the French FAMA U.S. Small Value Research Index returned 14.5% per year, outperforming the S&P 500 by 4.3. All data, French FAMA, is from Ken French's data library. In addition, the asset class outperformed after publication of the cross-section of expected returns in 1992. That's what I had read. My first introduction to investing was that right there, the cross-section of expected stock returns. And my professor in economics, Dr. Block, Howard Block, said, read this, and I read it, and I was off to the races. And, of course, I made a hell of a lot of mistakes since, but I remember reading that like it was yesterday. And then they had if memory serves, they had a book, not very thick, but it was a blue-covered book, and I forgot what it was called, the French Factor Investing. I can't remember, but it was about small value. That was the two factors, French FAMA, two factors. For example, from April 1993 through June 2019, the first passively managed fund to provide systematic exposure to the asset class, the DFA Small Value Fund, returned 11% per annum. The FAMA French U.S. Small Value Research returned 12.4% per annum, outperforming the Vanguard 500 fund of 9.4% by 1.6 points per annum. I hate that. They're two completely different points. I don't blame freaking what's his name here, Larry or I hate when we're comparing S&P 500 versus other things that are not S&P 500 related. I mean, small value stocks are not inherently S&P 500. They're different. They should be part of the portfolio, not comparing it. I don't get it. I think it's a mistake, actually, a lot of people to make comparison of their portfolio relative to the S&P 500 because the S&P 500 is, it's an actively managed index, right? I mean, it literally is. I mean, the Standards & Poor, they actively put funds, stocks, and whatever in there. In fact, I was just reading today that JCPenney is being delisted, I think, from the New York Stock Exchange. Nothing to do with the S&P 500 index, but I'm just saying there are things that make this actively managed. At the end of the day, though, if you have a small cap stock, the S&P 500 is literally not your concern. It's not. But you as an investor should have some small, some large. But to say this is better than that because this has outperformed, there's so much more that goes into this. All right, but small value has performed poorly in the decades since 2009. From January 2009 through June 2019, the S&P has returned 14.3%, where the small value research has returned 12.5%. And the Vanguard S&P 500 has returned 14.2%, outperforming the DFA's small value by 1.7%. Again, frankly, things ebb and flow. All right, so let's just keep going here. I was going to say something about that. I forgot what I was going to say. All right, all risky assets experience long periods of underperformance. Before you jump to any conclusions, it's important to recognize that the premiums to all risky assets are time varying. In fact, the S&P 500 index has experienced 3 of the last 13 years over which it underperformed riskless 1-month treasury bills. I think that's I could not agree with this statement more. I could not. The S&P 500 has experienced 3 periods of at least 13 years which it underperformed cash riskless 1-month treasury bills from 1929 to 1943, from 1966 to 1982. There we go. That big right there in 2000, 2012. So just because one has done better than the other in any given time frame means it's meaningless. I mean, so if someone's from 2000 to 2012 said, "I'm going to buy the 30-day Treasury bill because it's outperformed the S&P 500." You can't think like that. It was dumb to think like that. Thus, while the underperformance of small value over the past decade was unexpected, it should have been not a surprise. If this did not occasionally occur, there'd be no risk, and the risk premium would disappear. 100% agree. And remember why there's risk. Smaller companies are more volatile than larger companies because they're more likely to go kaput. Value stocks. This is what value stocks are not safer than growth stocks. Value stocks inherently are more riskier because they're value. They're lower PE ratios, higher priced or lower price to book, higher dividend yields. I mean, inherently that means they're value for a reason. They've been knocked down for some reason. Thus, they're riskier. The 3 long-term periods when the equity risk premium was negative, i.e. bonds outperformed stocks, also demonstrates that even 10 years of underperformance of a risky asset class is likely nothing but noise. They also explain why investors demand a large equity risk premium to begin with. In fact, I couldn't agree more. The issue on that with the 10-year thing is that you're like, oh, well, this hasn't done well, so I'm getting out of that. But then you might be getting out at the exact wrong time. And now what happens, though, this is what Jeremy Siegel talks about in his book, Stocks for the Long Run. There's going to be a few years in there on small cap value stocks, if you look historically, where they just freaking hit grand slam home runs in the bottom of the ninth with 2 outs and 2 strikes. And because that one swing, they just smoked the rest of they just smoked the rest of the field for years, essentially. That one swing, just a couple hits, and they were golden. But you have to be in there to have captured those hits. If you weren't in there, you didn't get it. And so you say, oh, man, that's small cap value. I'm getting in there, but nothing's happening. I'm getting out. Then the hit happens. You're like, oh, I'm telling you, you can't do that. If you're going to go small cap value, you got to stay there and be done with it. While investments have While investors have uncertain performance, valuations do provide information as to future returns. On average, lower valuations have led to higher future returns and vice versa. With that in mind, we can look at current relative valuations of the various U.S. equity asset classes and see how their recent relative performance has impacted them. The following data is from J.P. Morgan's 2019 Guide to the Markets. While U.S. large and small growth stocks have PE ratios that are above their 20-year averages at 101% and 116% respectively, and the PE ratio of large U.S. Value stocks is close to its 20-year average at 97%, the PE ratio of small U.S. value stocks, is well below its 20-year average at just 84%. The decade-long underperformance has led to a widening of the spread in valuation. So if you take say each stock has a PE ratio of 15 or 10 because I can do the numbers in my head. You get each stock class has a PE ratio of 10 is historic. Large cap growth will have a PE ratio of just 1% above that. So whatever that is, 10.1, I guess. Whereas small growth stocks will have a PE ratio of 16. Or that PE ratio, something like that. But you get it. And whereas small value stocks have a PE ratio of 8.4. And large value stocks, which is what I own, have a PE ratio of 9.7. From a historical perspective, small cap look cheap, the value stocks. But the fact that stocks appear cheap doesn't mean they cannot get cheaper. Yes. In fact, the evidence of short-term momentum in stocks makes it more likely that small value stocks will continue to underperform for a long while. And as a historical example, value stocks were very, very cheap in 1998, but they continued to get cheaper until March of 2000. I 100% agree. Similarly, the fact that small value stocks look cheap today doesn't mean they cannot get even cheaper. I think you just said that. However, over the long term, buying what is cheap has led to outperformance relative to buying what's expensive in every asset class, from stocks to bonds to currencies and commodities. I 100% agree with that, which is why I bought everything in large cap value. It's cheaper. Valuations mean something when it comes to future performance. Historically speaking, I have no clue what the future will hold, but I'm willing to bet my money on that, which I have. And while there is short-term momentum in stocks, there is strong evidence of long-term reversals, especially for cheap stocks. The odds favor that small value stocks are likely, but not certain, outperform. And while asset classes are time varying, there's little evidence that investors can time entry and exits, though there is evidence supporting the use of time series momentum in both asset classes and factors. don't even know what that means. Thus, patience and discipline are necessary ingredients to being a successful investor. Yeah, 100% agree. Let's see if we got any comments on this guy here. See what some other people say about old Larry. Nothing. All right, so I'm not going to comment on that, but that's I 100% agree. So let's pause for a second. This is the value, the Vanguard Large Cap Value Index ETF, V Victory Tango Victory, which I own. This is the only fund I own, and it has got PE ratio 16.4, a price to book of 2.2, a dividend yield. I guess it's not here. I don't know why I don't put the dividend yield in there. Anyway, we'll just go a small turnover rate. So this is all stuff that you want. So price to book low, PE ratio low. I don't have the dividend yield here, but all right, let's go back to the overview. I think the dividend was like 2.72 or something like that. Let's see what we got. Dividend yield 2.72. All right, so let's compare that to VOO or V. What's the large cap growth stock fund? Hold on, V Bug. I think it's Bug, right? Yeah, growth ETF. So let's compare that to the growth ETF, VUG. And let's see what we got here. Right in the bug. Yeah, there we go. All right, so the dividend yield on VUG is 1.06. And I think I went to portfolio management to get a look at what here we go. Price to book 6.3, PE ratio 27.5. So lower dividend yield, much higher PE ratio, much higher price to book. Still got a number over the 300 stocks, so a couple hundred stocks in there, just like the other one. Median market cap. Let's see, what's the return on this guy so far this year? I imagine this one's probably pretty stellar. Let's see, NAV. Does it give us a performance for year to date? I don't see a year to date, but for 1 year. Yeah, I don't see a performance of year to date. But for 1 year, from June to June, it was up 10.47. All right, so let's see what VTV did for that 1 year. Right there, 10.47 VTV. I have no clue. Did no, not that. Well, 9.94. It's not that bad. Well, let's see over 5 years. 9.27 for VTV, and we'll go back to VUG, and for 5 years, see what that has done. 11.99. There you go. 10 years, 15.68, and we are VTV is what? 13.72. So, I mean, it's definitely, it haven't got smashed. It's just, 2%, 200 basis points. That's pretty significant for 10 years, but it's not like VTV's got smashed. Let's just put it that way. So I'm pretty comfortable with this. I just like low price to book, high yields, and low PE ratio. That's what this value large cap does. I haven't compared the two on the small cap value, small cap growth, just because I don't own it. But anyway, I like what Larry's talking about. Hope you find this helpful. Smash the like button, subscribe, bell to be notified for future content, and we'll see you.